Okay, so what I'm gonna do is this. I'm gonna share my screen so that you can see what we have on the screen. Okay, I hope you can see the what I've shared on the screen. So today I've decided that we should stream this lesson on YouTube. So if you are joining us on YouTube, welcome. I'm DC. So today we're gonna be learning about candlestick patterns. We'll be learning about candlestick patterns and how we can master our price action using candlestick patterns. So there's a lot of information that is carried within each and every candlestick. So basically that's what we're gonna be looking at. Let's see if we have people who are joining us. Okay, it's fine. Let's just continue. So, like what I said, there is a lot of information that is carried within each and every candle. So some people they refer them to the as the Japanese candlesticks. They came. I think they came from the Japanese. I don't want to talk about the history of the candlestick, but what we want to learn, about the different candlesticks, how we can apply them when we are trading. So this applies when we talk about price action. Price action is relatively constant crash, your derivative synthetic indices, your gold, your forex, your cryptocurrency. We still have the same thing. So if you go on a chart, you have the choice to choose candlesticks. So within those candlesticks, that's what we're gonna be learning about. What exactly do those candlesticks tell us? So we're gonna start with the basic structure of a candlestick. The basic structure of a candlestick. So that's what we're gonna be looking at. So when we look at a candlestick like the normal candlesticks that we know when that's the body of the candle. So with the candle, we have a body. Then we also have what we call the upper shadow and the lower shadow. So we have the upper shadow, which is this part, and we also have the lower shadow. So this is the body of the candle. All this from the bottom part here, we call it the candle range. The upper shadow, the lower shadow, and the body, we call it the candle range. So these are the basic structure of a candle. So let's look at still on the basic structure of a candle. So let's look at the different. Sometimes when people are giving signals, you hear people saying probably the RSI is being applied to close or to open. What does that mean? They'll be referring to the different price levels that will be there on that particular that will be used for the calculation of that particular indicator. So we have the following. So the candlestick has the four main parts. It has a high. So we're gonna start. We have two types of candlesticks. We have a bearish candlestick and a bullish candlestick. We have a bearish candlestick. So this one is a bearish candlestick, and we also have a bullish candlestick. This is a bullish candlestick. So the bullish candlestick will be moving up. The bearish candlestick will be moving down, as denoted by these arrows that you see here. So this one, it means that it's coming down, and this one is moving up. So the four main important parts of a candle is that we have the high of a candle, which is this particular level up here. This is the high of a candle. And we have the low. So what happens within this candle is this. So when this candle opened, this is the opening. So be it on a daily chart, or be it on a 1 hour chart, or be it on a 30-minute or 4-hour chart. When that candle, the particular candlestick, so I'm gonna use the daily candlestick. So assuming this candle is a daily candlestick, when that day opened, when the trading session was opened, the price that this candle opened at is this particular level here. So this is our opening price, and during the particular day when the candle opened, there was a time when the price actually moved upwards. It moved upwards, and then before it closed, then it also moved downwards until it reached this particular level here, which is the low of the day. But before the day ends, the price was moved. Give it to me. Let me check something. Sorry, guys. Wait, wait, wait. Um. Oh, I didn't share your screen. I didn't. Shares, can you now see the screen? So unfortunately, the person that I'm having a lesson with wasn't able to see the screen. Shares, can you see the screen now? You can't. Oh. Let me try to share it again. Can you now see the screen? It's fine now. Can you now see? Yes, okay, it's fine. Okay, it's fine. Let's continue. So within each and every candle, there's an internal war that is being fought between bulls and bears, between buyers and sellers. So what will normally happen is this. So by just looking at a candle, there's a lot of information that is embedded within that candle that you can actually use for your trading decision. So what you can see is this. When the candle opened, so what will be happening is this. The sellers will be pushing the price down and the buyers will be pushing the price up. So when this candle was opened, and within each and every candle, you see who won the battle between buyers and sellers. So when the price opened here, these buyers took over the control of the market, and they were able to push the price until it reached this particular high. But the sellers, they stepped into the market and then they started to push the price until it reached this particular low. But before the day ends, the buyers stepped into the market and then they started to push the market, but they were overpowered by the sellers and couldn't push the price further up. And then the candle closed at this particular level here. So within this bearish candle, so this is a bearish candle, we can see that within this bearish candle, this is a bearish candle, the battle was won by sellers. So the sellers were able to push the price from the opening to where the price closed. So they won the battle. This means that in this particular day, the candle or the market was bearish. Why? Because we had more people who were selling than were buying. So by just looking at this, we can see who was in charge of that particular market. Then let's talk about the bullish candle. Let's talk about the bullish candle. So we have a bullish candle. So this is a bullish candle. So when the market opened here, so what will happen is this. The opening price, so these are different price range. Here, this is the high, this is the open, this is the close. These are different price levels. So when the market opened, so since this is a bullish candle, the market will open at this particular level here. And they sell in charge and they were able to push the price to this particular low here. This is the low of that particular day. But the buyers, they stepped into the market and then they started to push the price upwards until it reached this particular high. But before the day ends, the sellers also took charge of the market and were able to push the price here until the price closed. The buyers, there were more people who were buying. That's why the candle, the market ended upward, closing above the open. So basically what we can see is that in this particular market, buyers were in charge. So this is what you can, the analysis of different candlesticks. So let's quickly look at, so we now know that the candle is in high, the candle is a close, the candle is an open, then the candle is a low. Those are the four important part of a candle that we need to know. Okay, let's quickly look at the different types of candlesticks that we have. So I did a video, I think on my channel, where I was explaining about, I really took time to explain about pin bars. So there's a video on my channel which you can also look at, which also talks about candlestick pattern. The video was talking about candlestick pattern. Okay, so let me quickly look at this. So the different types of what candlesticks. I'm gonna first of all look at the pin bar. So with the pin bar, we have two types of pin bars. We have a bearish pin bar, which is also called a shooting star. Then we also have a bullish pin bar, which is also called a hammer. So these are the two types of what pin bars that we have. What are the key features that we need to know, or a candle needs to have, for it to be called a what? A pin bar? What are the characteristics or the features that the candle needs to have? Because sometimes we also have what we call a doji candle. It also looks similar to a pin bar, but it's not like a pin bar. So one of the things that you would want to see is that the first key feature that you want to see is that the length of the wick must be at least 3 times the length of the body. So sometimes people would say if it's at least 2 times the length of the body, it's fine. But we're gonna stick with at least 3 times the length of the body. So what this means is this: the length of this wick. Okay, we're talking about shadow. This we said upper shadow and lower shadow, but this can also be called a wick. We can also call it a wick. We can also call it a wick. This part of the candle, we can also call it a wick. So this is the upper shadow, and this is the lower shadow. Or we can also call it a wick. So this wick that you see, is some people will call it a tail, or they will call it a wick, or some people will call it a shadow, the upper shadow. So what you would see, what you want to see when we are talking about pin bars is that it must be at least, this one must be longer, and it must be at least 3 times the size of the body. So when comparing the distance from this high to this particular level here, this wick must be at least 3 times the size of the body. So that's one. So be it bearish or bullish. So for example, you can talk about pips. So if this is 3 pips, the body must be at least 1 pip. That's one. So the length of the body must be at least 3 times the length of the wick must be at least 3 times the length of the body. Then another key feature is that when we are looking at pin bars, the body of the candle, it mustn't be located near the middle here. It must be located near, okay, we are now talking about a bearish pin bar, which is a shooting star. It must be located near the low of that particular candle, not here at the middle, because it would look like a doji candle. Then also this body, when we're talking about a bullish pin bar or a hammer, it must be located near the high. That's another feature that we can talk about. Number 3, we can also talk about the nose should be smaller. So when comparing the body of these candles, when we're now comparing the body, the length of the body, when we're comparing the length of the body, this one, and the length of this nose, the nose should be smaller. Or this lower wick here. Okay, let me just check something. Shaz, can you see the screen? Are you able to see the screen?
No, to see.
Okay, it's
No, I can't see anything.
okay. Let me try to share it again. Can you now see it? Hello, Shaz.
No.
You can't see again.
Hello.
Yes. Can you now see it? There's nothing.
Let me check. No, nothing.
Oh, okay. Let me share it again. Can you now see the screen?
No.
Is it fine if you can rejoin?
Okay.
So we are trying to look at the characteristics that make up a pin bar. So what are the features that you should be looking for you to know that this is a pin bar? So that's what we are currently trying to establish. Let me share the screenshots. Okay. Can you now see the screen? Hello?
Yeah, nothing to say.
You can't see it again. Okay. Is it fine if I send you the link?
No, that's
YouTube, because I'm
no.
YouTube. Is it okay?
Yeah, I think yeah, it's okay.
Okay, let me share with you because I'm streaming on YouTube. I don't know what's happening today.
There's something that is, but yeah, it's only showing the meeting.
It's only showing the meeting.
It's only showing the meeting. It doesn't show your screen.
Okay, it's fine. Shade, just click on that link so that you can also see what I'm sharing on YouTube because I don't know what's happening. Okay, do you now have the link?
Did you share it on WhatsApp?
No, I didn't share it on WhatsApp. I shared on the chat. Can I proceed?
Uh, 1 minute.
Okay, it's fine.
Okay, okay, yeah, I got the link.
So is it, but you do also want to ask questions, so it's fine. So as we'll be going, you have the floor to ask questions, so you can also check on YouTube. Okay, so let me just continue. So we're now talking where we're talking about the nose should be smaller than the size of the body. So when comparing the size of the body, this upper wick, when we're talking about a hammer candle or a bullish pin bar, should be smaller than the body of the candle. Then this lower wick here, when you're comparing the size, it must be less than the body of the what, of the bearish pin bar, which is a shooting star. Feature is that the long tail or the wick must stick out of the surrounding candles. So when we look at the candles, this bullish pin bar, the wick must stick out of the surrounding candles. It must stick out like here. It is it is on its own. It's sticking out. It's on its own. Basically, that's what I'm trying to say. So these are the 4 characteristics or the 4 features that you use when you're trying to know if the candle is a what, is a pin bar. So the psychology behind the pin bar, why is it whenever you go to your charts, for example, let's quickly go to the charts because we want this to be more practical. Why is it when there is an appearance of a pin bar? You see here we have a pin bar. You look at this particular area. Here we have the pin bar. This is a pin bar here. In most cases, when there is an appearance of a pin bar, the market would tend to reverse. Let's try to identify more here again. So on major turning points, here when the market is reversing, sometimes we can have the presence of pin bars. Why is it whenever we have the presence of pin bars, the market will tend to reverse? And I can see another one here, although this one, it's not sticking out from the surrounding candles. Let's look for more. It's a very, very common candlestick pattern. You see here again, we have a this one has a bearish pin bar. This one was a shooting star, although it had the what, green color, but it's a shooting star. In most cases, when the market is reversing, these candlesticks are always there. So by just identifying this candlestick, you can actually develop a trading plan, especially when they appear on levels of resistance and support. You know that there is a high chance or a high probability that the market is likely going to reverse. So why is it? In most cases, in most major turning points, the market will tend to reverse when there's the presence of what, of these pin bars. So what is the psychology behind these pin bars? So that's what I want to explain. Get confused. So let's quickly go to this one. this one. So let me start with the bearish pin bar. Let's start with the bearish pin bar, which is a shooting star. We are focusing on this. So we are focusing on this one. So why is it in most cases when there is a appearance of these pin bars, the market will tend to reverse? So like what we established when we explaining the different parts of a candlestick, we said with this candlestick, this one, it will open at this is the opening price. We have our opening price and we have our closing price here. So why is it the price will tend to move in the opposite direction? Assuming that the price was in an uptrend when it reached this level, assuming that there was also a level of resistance, price reached a level of resistance, assuming this is the level of resistance, why is it price would tend to move in the opposite direction? So that's what I want to establish. That's what I want to explain. Okay, so what will happen is this: when the market opened, the price was here. And then during the course of the day, this is the daily candle control of the market. When this guy, this was a bullish what market. This is a bullish market. The price was moving up. And these guys, they had that mentality that since the price was moving up, they ignored the fact that there was a resistance here. Then they bought. Like their decision was correct because the market then moved upwards. So these guys, when they bought at this particular level, thinking that there was going to be continuation, they were in profit. They were in profit. So we have people who bought at this particular level here. And some people, because they are not sure of what exactly is going to bought at this particular level and this particular level. During the course of the day, they are enjoying profits. They are actually in deep profit. But what then happens is this: before the day ends, the sellers or the bears stepped into the market and then they started to buy. They started to sell, They started to sell and sell until price reached this particular level here. So we have sellers. We have a seller, one at this particular level, who sold. When he sold, one, he was in deep loss. But he was just holding because of the fact that there was a level of resistance. And some even started to sell at this particular level here. And before the day ends, let me just remove this one. I want to remove this one. Before the day ends, these guys who sold at this particular level are now in deep profit. So we have buyers here who are now in a loss, and we have sellers who sold. This guy, another seller who sold here, was in loss, and now before the day ends is now in profit because the candle closed at this particular level here. This was the closing price. So we have two people. We want to understand what is going through the mind of these two people. One, with buyers during the course of the day, they were in profit, but before the day ends, they are now in deep loss. And we have sellers who are now in what? In profit. So the psychology that normally happens between these two people is this: the buyer is going to hold on to this trade, and the sellers are optimistic about what is going to take place or on the next day. So the reason why price will tend to reverse is this: some of the buyers are now in deep losses. So what are they going to do? They're going to close. They're no longer optimistic about what is going to take place in that particular market. So what are they going to do? They're going to close their trades. So whenever you close a buy trade, you automatically open a sell trade. Have you ever noticed that? So whenever you close or your stop loss is hit when you're buying, just automatically that or the way you close your trade is automatically fueling the selling pressure. So we have buyers who are closing their trades, adding more to the selling pressure. And we have sellers who are optimistic about the next day, who are holding on to their position. So that's the psychology behind these candlesticks. That's why whenever you see the presence of a pin bar on a level of support, it is reversing because of what I've just explained. In a bearish pin bar or a shooting star, the buyers are no longer optimistic. Some of them would actually close their trade, adding more to the selling pressure. And we also have sellers who are now optimistic about the next day. They are holding on to their trade because they are now in a winning position. So this is the reason why price will tend to reverse when there's a presence of a pin bar. Then when you look at a bullish pin bar, we have the following. In a downtrend, price is moving down. But price as we are assuming that price has reached a level of what? Of support. This is a support level and price is in a downtrend. Why is it price will tend to reverse and move upwards? This is what I want to explain. So we have the following. One, people here at this particular level, some sellers who sold and some buyers who also bought at this particular level here. And some during the course of the day, they also bought and they also sold. Okay, let me just do this. So I'm gonna use blue for buyers. We have buyers who bought at this level. Then we also have other buyers who bought at this level. Then we also have sellers who, when the market opened, they sold here, and some even sold here because they now saw that the price was now moving down. This is what most people would do. They would want to see, okay, the candle, is it bullish or bearish? Okay, I can see now the candle is moving down. So let me say, because I can see the price is moving down. So we have sellers who sold here and sellers who sold here. I want to first of all explain what will be taking place to the down and reached this low here. But before the day ends, we have the sellers step into the market. And we now have more people now selling, and they were able to push the price upwards until it reached this high and eventually closed below this level. So of these sellers who sold at this particular level here, they were in profit, but before the day ends, they are all now in loss because price closed at this particular level here. So these sellers, obviously, they are no longer optimistic, but some of them, especially those who sold at this particular level, they are no longer. We now have sellers who are now closing their trade, adding on to the what? To the buying pressure that is there in that particular market. Then we also have buyers who bought here. During the course of the day, these guys were in what? In losses, but before the day ends, they are now in what? In deep profit. So we have sellers who are no longer optimistic about holding to their selling position, and we have buyers who are now optimistic. Why? Because they're now in profit. They are going to hold to their buying positions. So what will then happen is this. More sellers will close their trade, adding on to the buying pressure. And we have buyers who are now holding to that to their candle. So that when I started trading, why is it whenever I see a pin bar, why is it the market is reversing? Why is it most cases when there is any presence of a pin bar, why is it the market is reversing? It is because of this analysis that I've given you guys. It is because of this analysis here. So you now understand why price will turn. And I talked about the fair level of support or a level of what? Resistance. Because they carry no value when they appear, for example, when they're appearing at a level here, at this particular level here. Probably you can talk about continuation, but where they have the greatest what significance is when these candlesticks appear on a level of support or resistance. Okay, it's fine. So let's just continue. So we've talked about the psychology behind the pin bar. With the way that I'm explaining, I'm afraid that I'm not going to be able to finish everything. The next one is gonna be okay, we're done with this one. We talked about the psychology behind the pin bar. Then okay, I was just explaining. So how do we trade using a pin bar? How do we trade using a pin bar? So I have a strategy that you guys you can use when you're using a pin bar. So the first thing that you need to do is this. You need to identify your levels of support and resistance. Once those levels of support and resistance have been established, you then have to wait for the appearance of a pin bar. So once we have a pin bar like here, on a level of support, what are we going to do? We don't immediately jump into the trade, because what you would normally see is this price will tend to move downwards, maybe to retest this level here. Sometimes you can have a double pin bar. Some people, they call it tweezer, a double tweezer. So sometimes you don't want to be caught in that drawdown. So what is the best way to trade them? I would recommend using what? Buy stops. So a buy stop, you place it above the current price, assuming that probably the price is at this particular level here, here. So there are two ways. You place your what? Your buy stop just above the the upper wick of that candle area here. What is that buy stop indicating? You want to buy when prices moved upwards, when prices manage to push upwards. That buy order will then be triggered, and then automatically you're in that trade. Why is it not a good idea just to buy when this candle is formed? Some people would also actually make a mistake before the candle even closes. They say, this is a pin bar, so I'm just going to buy. You need to wait for the completion of the what? Of the candlestick. Once that candlestick is fully closed, that's when you can now think of buying opportunities. So what I would recommend is this. Some people would immediately on the next candle open, they would just buy. But using pending orders, one, it gives you the edge to what? To enter the market when the price has gained enough bullish momentum, when the price is now ready to move upwards. So if you place your buy stop here, you're now in a position when the price, even if the price drops, because sometimes in most cases price would then move downwards, but you want to enter when price has gained enough momentum to move upwards. So using that buy stop will enable you to what? To do that. So using pending order is one of the most effective strategies that you can implement, and your stop loss has to be just below this bottom wick. And still on the pin bars, the bottom, the wick here, what does it represent? It represents rejection. Price rejection. Price is being rejected to move further downwards. So that's why you'd normally see price. Then you want to see some signs of rejection. The signs of rejection will be this week here and the appearance of a pin bar here at the level of support here. Once that is the case, you know that I'm going to place my stop loss just below the wick here. I'm going to place my stop loss here. And my take profit, when it comes to the take profit, it has to be, so you can make use of ratio, a 1:2. So if you're entering here, this is probably 1. When it reaches 2, it's fine. Or you can make use of the recent swing high. The recent swing high, and you target that level, and you'll see in most cases price will then move upwards and hit your take profit. So this is the same thing when we are also talking about when you're also talking about a shooting star. With a shooting star, you'd want to wait for price to come to a level of resistance. Then when there's an appearance of a shooting star, you then have to wait. This is a shooting star. Wait for the candle to close. When the candle closes just below the lower wick or the lower shadow of the candle, you then have to place your sell stop, so that when price has gained enough momentum, it will trigger the sell order, and then you can sell and target this particular swing low here, and your stop loss will just be above the recent the above the what? The wick of that candle. Then you are done. So this is how you trade using pin bars. So this can be a trading strategy which is very, very easy to implement. Identifying your support and resistance, waiting for the appearance of what? A pin bar. Then you no indicators, no what? Because you know that there are high chances when price, when there's an appearance of a pin bar at a level of support or of resistance, the price will tend to what? To reverse and move in the opposite direction. Okay, we did this. We went to the chart. Let me just do it again. Let's just go to the chart and try to identify if this is true. If you can have, let's just look at VIX what? VIX what? VIX what? VIX 75. Let's look at VIX VIX 100. Let's look at the VIX 100. So this also applies in boom and crash. This also applies in any financial market. In any financial market. Okay, let me just do that and show you guys that this is true, not only in synthetic but in any financial market. Here I can see we have a hammer candle at this particular level here, and what then happened here? Price reversed once there was an appearance of these rejection candles. Some people, they call them rejection candles, but they are just pin bars. And here again, we also have a pin bar. And what happened? Price reversed. Let's look for more examples. This one is a pin bar. And price reversed. So in most reversal points, you would see that there will be this appearance of these pin bars. You see this. You also see here, there are many examples that we can see. So this can be a trading strategy that you can just use once you have identified your level of support and resistance. Then wait for these pin bars to appear. Then you take your buy or your sell. Your stop loss just it will be below or above that wick of that, depending if it's a pin bar, if it's a bullish or bearish pin bar. Okay, let me just look for one example, then we can move forward. Okay, here we also have some candles. If you look at these candles here, bars. Okay, and I just want to identify these pin bars. Okay, the next candlestick pattern that we're going to be looking at is the Doji candlestick pattern. So with these candlestick patterns, they are grouped into two groups. We have complex and simple candlestick patterns. So the ones that are alone, when we are looking at a single candlestick pattern, it is called a simple candlestick pattern. And these ones, they have less weight compared to complex candles. Complex candlestick patterns, they have two or more candlestick patterns in that particular pattern. So what we are currently looking at, these are simple candlestick patterns. So with the Doji candlestick patterns, so when we talked about pin bars, I forgot to mention that these are reversal candlestick patterns. When they appear, in most cases, the price will tend to reverse. But when we are talking about a Doji candlestick, a Doji, sometimes it looks like a pin bar, but it's not like a pin bar. I'll explain the difference that is there. So with the Doji candlestick pattern, what you have to know about Doji candlestick patterns, these ones, they are neutral candles. They are neutral candles. So how do you define a Doji candle? A Doji candle is an open and a closed price at the same price. There is no candlestick body. So there's no candlestick body. This is how you know that this is a Doji candles. And we have different types of Doji candles. It's going to continue moving downwards. But you can also look at some of the things. I will show you what I'm trying to say. I can't say it now. Let's just continue. Let's look at the different types of Doji candles. So I've prepared 1, 2, 3, 1, 2, 3, 4, 5, 6, about 6 Doji candlesticks, 5 candlestick patterns. So we have the normal Doji. With the normal Doji, so we're talking about, this is the normal Doji. With the normal Doji, you would see that the open and the close. With the gravestone Doji, the open and the close is located near the low. And we have the high here, and it also looks like a shooting star. And because of this big wick here, we can say that there is a form of rejection. And sometimes they can, when they appear on a level of resistance, price will tend to reverse and move upwards. Although we don't want to make decision basing on the Doji. Then we have the long-legged Doji. With the long-legged Doji, that's a long-legged Doji. So let's quickly go to the chart and look at these different types of candlesticks. Okay, what are you guys saying? Yes, complex candlesticks are those that involve 2 or more candlesticks. That's true. Identify a level of support and resistance. Wait for the retest after the pin bar is shown. Better to place a buy stop. Yeah, making use of pending orders. That's true. Okay, let's just continue. Okay, let's quickly look at the charts and try to identify these different types of candles. Doji candle. So this one is a long-legged Doji. This one long-legged Doji. And let's look for more. So close to each other. So it opens and closes at the same price. Let's look for more examples. Candlesticks that have no body. This one is a Doji again. Shh. Okay, this again is a Doji. And again, and you see, when they appear, you can't talk about any direction. You can't talk about any direction. You see here, again, we also have, this one is a dragonfly. It's located near the high, the open and the close. Then, which one do we have? Let's look for more. Then we also have this one. It looks like a 4-legged Doji. They're just neutral candles. they have no body. So to me, I don't really base my trading decisions on dojis, but for educational purposes, you just need to know that there are different types of what candlestick patterns that are called doji candles. So let's look at the complex candlesticks. With the complex candlesticks, there are two or more candlesticks, two or more, a combination of two or more candlesticks. We call them complex candlesticks. And the first one that we're going to be looking at is an engulfing candlestick. So with an engulfing candlestick, we have so these are reversal candlesticks again. These are reversal candlesticks. So what you would want to see is this: after identifying your support and resistance, and the presence of a doji candle at a level of resistance. We're now talking about resistance, assuming that this is a resistance and these are daily candles. So the previous candle was a bullish candle and it pushed the price at this level, and the next and probably today's candle was bearish and it closed below the open of yesterday's candle. So what you would want to see is this: one, the length of the this bearish candle to engulf or to cover the body of the previous candle. That's one. And the bearish candle, this one is not it's not that important. This might appear maybe in Forex, where the bearish candle opens, candles open here. It closes below this open here. This candle closes below the open of this candle. So this is a bearish engulfing candles, and you want to see them at levels of what? Of resistance. In most cases, when there is an appearance, you want to see these bullish engulfing candles at levels of support. So probably assuming that this is a level of support, this is a level of support here, and there is a what? A bullish engulfing candle here. This is a support level and there's an appearance of a bullish engulfing. In most cases, price would tend to, there's a likelihood that price would tend to reverse and move in the opposite direction. So here you would see that these are daily candles. The previous, this was the support level, and then today's candle closed above the previous day's open here, and the body of this candle covers the body. So let's quickly go to the chart and try to identify and try to come support and resistance. That's the first thing. And now okay, assuming that this is we're just making assumptions, this is a level of what? Assuming that this is a level of resistance, let's be more practical. Let's try to identify where there was a level of resistance. Okay, what we can see here, okay, I want to make use of, okay, we can talk about this particular level here. Focus is on this particular level here. We've managed to draw our support and resistance. I'm not saying that this is the correct way to draw a support and resistance, but we're just saying that this is a support level. That's the assumption. And what we can see here, when price came back again to that support level here, what do we see? We have two candles. We have this one. Let me try to zoom in so that you can see. We have two candlesticks here. And on a support level now, we have the appearance of a bullish engulfing candle. So how then do we trade using this? How then are we going to buy in that particular market? One, like what I suggested, you can make use of a pending order. You place your pending orders here, wait for the candlestick to close. You place a buy order, buy stop, just above that the candlestick close here, and your stop loss has to be below this candlestick pattern, somewhere here below the support level and also below this candlestick pattern, such that if there is a candle that is going to come down and make a retest of this particular level, so you just place your stop loss just below here. Your entry is gonna be, so your stop loss is here, let's just choose red, and your entry is gonna be at this particular level here, and you place your order like that, and then you target the next the recent swing high. So here our recent swing high, we can talk about this point 1:1 here. When you target this area, it was like a 1:1 here. So here you're going to get probably a 1:1 from here to here. This you can target this, and you can also target the next candlestick open. So basically that's how you trade, making use of a pending order, a buy stop here, placing your stop loss just below here, and you target the recent swing high. So you can target this one or this one, and you can see it was a winning trade. So let's look for another example where we also had a demystify, where we had a bearish engulfing. So at this level we had the following. Yeah, we had this bullish candle and this bearish candle, and the body of the bearish candle was engulfing the body of the previous bullish candle. And what happened? Then the price started to move downwards. So let's just try to identify it, and then what then followed after we had that kind of price action. So if you can master this, I'm telling you, trading becomes easy. You're not using any indicator. Your chart is very clear. You're just using your price action. Sorry. Okay, here again, we also have a bullish engulfing candle. Sorry, I think I need water. Yeah, I think I've been talking for a very long time. Yeah, my voice is now getting tired now. To cover. Where else? I'm trying to look for a bearish engulfing candle. Where do we have one? Where do we have one? Yo. At least one example will be fine. Let me go to the 1 hour. Then when it comes to time frame, they carry more weight when the candlesticks on. When they appear on high time frames, they have more weight. So the higher time frame you go, the more powerful this being. Okay, here, although it's not a level of resistance, I'm trying to look for at least one example. Yeah, yes, we can talk about this one. And one we had the resistance level here, and we had appearance of. So you're waiting. These are your trigger. So what are you waiting for now? You're waiting for price to give you a signal. Once prices manage to return to your resistance level. Once price returns to your resistance level, you're waiting for your entry trigger, your signal that is going to tell you that now price is ready to move downwards. So the appearance of a bearish engulfing candles here. So that one was going to be your signal. Your stop loss, probably you're going to place it just above this the resistance, just above the resistance. Your entry was going to be here. Your stop loss was just going to be above the resistance, and then you can see it was going to be a winning trade. You're going, or you can just manage it as the price will be moving down. You move down with the price, and you can see you're making use of a trailing stop. You're now making use of a trailing stop so that you can get more from the market. How you can make use of this bullish and bearish engulfing candles that we're gonna be looking at, which is the morning and the evening stars. So the more candlesticks that you have, so with more, when we are comparing simple candlesticks and complex candlesticks, the more candlesticks that are there in that particular candlesticks, the more relevant or the more significant that particular candlesticks is. Okay, so in this particular example, we'll be looking at a 3 candlestick pattern, which is called the morning star. So with the morning star, you have the first candlesticks, and you would want to see this on level of support. You've drawn your support and resistance, and now you wait for your signal. The signal is going to come when you now have a morning star. So the morning star will be comprising of 3 candlesticks. We have the first candlestick, which is a bearish candlestick. With the second candlestick, which is a very small candlestick. Then we have another bullish candlestick here, which is this one. So with morning star, the bullish candlestick missed 50% of the first candlestick. So this is the first candlestick, second. So when you are numbering candlesticks, I also code and make robots. Let me tell you something that might be important. So when we are looking at candlesticks here, when we are numbering or identifying them from the chart, when we are coding, I make robots. This one is called 0. The current candlestick is called 0, and the next candlestick is called 1. And the next candle after that one is called 2. So they're numbered going downwards. That's why when you're calculating your moving average, you say moving average 10. So what are you saying when you say moving average 10? You're counting 10 candles going backwards. For example, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So these candlesticks, these 10 candlesticks here, are the ones that are going to be used. The close, or be it the open of these candlesticks, will be grouped, and you come up with a moving average. That's how you end up drawing that 10 moving average, or the 200. So with the 200, you count 200 candles going backwards, and they calculate, you know how to calculate moving average. I'm not going to talk about how moving average are calculated or what, but I wanted to bring your attention on this. The current candlestick is called 0. The next candlestick before that, or the previous, will be 1, 2, 3, 4 going backwards. So when we're looking at now looking at what? The morning star. So this one will be the current candlestick. So this is our candlestick 1, 0. This is 1, this is 2. So the close of this current candlestick 0, should close above the 50% of that candle. So you measure with your Fibonacci 50% is that one is a morning star. So it's a reversal candlestick. When the price is in a downtrend, when there's an appearance, the first candle, you know that there's a likelihood that the price is likely going to reverse and move upwards. We can make use of a penning order. You place it above here, buy stop, and then when the price is now gained enough momentum to move upwards, you then buy and you go up with the market, and then you place your stop loss just below this particular level here. Then we also have what we call an evening star. We have a morning star, evening star. Morning, the sun will be low. Evening, obviously, to be up. So you know that if it's evening, that means the price is moving down. If it's morning, that means the price is likely going to reverse and move upwards. So we also have the same thing here. This first candle, second, and the third, but we say this one is 0, this is 1, this is 2. So I'm just going to go to the basics. So this first candle, this candle, the current candle here, and this one is a bullish candle, and this one is a bearish candle. So there's a likelihood that if this one closes below the 50% of the first candle, there is a likelihood that the price will then reverse and move downwards here. So let's quickly go to the chart and try to identify these candlesticks. I saw one candlestick. I think I marked it, but it was on H4. It was on H4. I just marked it. I saw it and I said, when we're talking stick, I'm gonna use it as an example. So this one is a combination of 3 candlesticks, 3 candlestick patterns. We have the morning and the evening star. So how do they look like? Something like this, but this one is not a good example because this one, but it's an evening. This one is an evening star. Well, let's look for a perfect example. Stars, and in those cases the price then reversed, and here we can talk about an evening star. Here, there's 3 candles that we have here. Then you need your Fibonacci to measure if it was able to close 50% of the first candle. So I'm gonna take my Fibonacci and I'm gonna measure from this one, the body. We are concerned about the body, and you can see that candle, this one, I hope you can see what I'm saying. Sometimes you might think that it's obvious. This one, it closed above this 50% level here. So this one was a morning star. And what do we see after that? We can see the price then reversed and started to move. The recent swing high is always here. You can target this area. And like what I said, it has to be on a level of support. And I'm happy that this one will be a perfect example because it was on a level of support. Here we have a support level. We have this support level here. And we had the appearance of this one. And you can see once these candlesticks appeared, this ones, once they appear, the price then reversed and then started to move upward. So this, what I'm teaching you guys, is really practical. It's something that you can actually adopt in your trading strategy, and you can just make use of without any indicator. A blank chart like this one, this is price action. You can actually start trading and making money by just making use of these simple candlestick patterns. Okay, Shaz, do you have questions? Shaz, do you have questions? Oh, Shaz left the meeting. If you guys have questions, please can you ask so that I can assist you. Let me just go through the charts. I can see the screen. Hope I didn't mismatch. Oh, okay. Please go ahead, Mr. Fikayo. Fikayo. Please like and share this video so that this content can be advertised or suggested to many viewers. So as a content creator, if you like and you subscribe to this channel, that's how we grow. That's how the channel to ask the question. Just type it in the chat box, and then I can assist you from there. Shaz, I wanted you to ask questions. If it's possible, you can join and teams and you can ask. Okay, let me read this question. Okay, for a swing trader, what time frame is the best to make use of this price action? Okay, so with me, I would normally, if I'm going to analyze, I would do my analysis on the daily or the H4, where I will do my trend analysis and everything. Then they are more relevant, especially if you give yourself to say that I'm just going to focus on the 1 hour. But I did my analysis on the daily. I did my analysis because I don't want to go to the 50 minutes. Oh, it's my 5 minutes and identify this. They become so deceiving. But if you go to your 1 hour, you'll be fine. These candlesticks will actually have more value rather than going to your lower time frame. Stick to your 1 hour, it's fine, but do your analysis on the daily and the 4 hour. And also for a day trader, what time frame should we look out for to make trades? So you can so you just have to be careful now. If you're a day trader, identify these candlestick patterns on your 15-minute time frame depending on the assets. If it's booming crash, it becomes tricky. It becomes tricky if it's booming crash when you want to identify these chart patterns in booming crash and you go to your 50-minute time frame. I don't think they really have any significance. But when you talk about volatility, Forex, and other financial markets, going to your 50-minute time frame is fine. Even going to your 5 minutes time frame to execute your trades on high time frame support and resistance, and you try to identify what is taking place on those lower time. This one is a funny question. Does this have any effect on your equity? Obviously, because you're executing trades using this, it's like a strategy. You're learning about these candlesticks so that you come up with a strategy. So any strategy is an impact on your equity. Okay, thank you so much, Mr. Fikayo, for asking this question. But I was waiting for Shaz. I hope she's still around to join and probably ask 1 or 2 questions before we call it a day. For instance, someone who spent $5 on equity. Well, for your stop loss, no, you will be probably off a engulfing candle on the H4 or the engulfing candle on the H1. You need to go down to your 50-minute time frame, your 5-minute time frame, so that you can execute your trades with a tighter stop loss. I think if I say it in that way, I think it will be easy for you to understand. Guys, I think Calvin say thank you so much. I hope what I've been sharing with you guys was hopeful, and I just thought that I should share with you guys some of the. So I've been doing this for years. It's just that I don't normally produce such content. It's not like I don't know about candlesticks. I don't know about price action or smart money concept. But in my mentorship program, this is basically what we do. So if you're interested in learning more about these things, for example, with our price action courses, where we'll be teaching you about market structure, how to do trend analysis, candlestick patterns. We have more that is still there on candlestick patterns. Then we'll also be talking about price action strategies. How do you draw your support and resistance strategies, and reversal strategies, breakout and fake outs. How do you trade breakouts and fake outs? We have a lot that we have on our mentorship programs. Then we'll also be teaching you about smart money concept, indicator based strategies. We have some hidden strategies that I haven't shared on YouTube that are there for your own information. The one I am happy that the spike, the boom and crash spike strategy, the 106. I've been keeping this strategy for 7 years. So it doesn't mean that I only have one. I have a lot of strategies that I don't share on YouTube. So I will review when you join our mentorship program more of these strategies. So guys, thank you so much for your time. I now understand. Thank you. I'll also rewatch. Thank you guys for your time. I'm tired. May you for the losses that you might encounter. And I want you to make use of I recently created a risk management to the DC for derivative markets. So I saw that there was a lot size calculator for Forex and cryptocurrency and all those markets, but we didn't have one for derivative synthetic indices. So I over the weekend I created one, which is this one, the DC derivative synthetic indices lot size calculator, and it has all the indices. You can see here, you can choose which index do you want to use. So you can use this as a risk management tool. So probably you want to maintain a risk percentage of 2%, and you have a 5,000 account. Your account is 5,000, and you want to know. So how basically do we make use of this lot size calculator? We want to make use of a 2% risk percentage, and we want to know which lot size are we going to make use in this particular level. So you need to calculate your stop loss in pips. Then probably you have a 40%, 40 pips. You've calculated the difference between your entry and your stop loss, the difference between the price, and you've noticed that it is 40 pips. Then you select which asset are you going to be looking at. Is it jump 25? Is it boom and crash? Maybe it's boom 1000. Then you just click here. It will tell you that in this particular trade you need to use a lot size of 2.5 so that you maintain the same risk percentage here, the same risk percentage. And we also have a mentorship class that we're gonna be unveiling on Saturday, where I'll be teaching you guys on trading psychology and risk management. So basically, we'll focus on those particular two subjects where I'll be teaching on trading psychology. How do you develop the mindset of a how do you develop the mindset of a profitable trader? What are the things that you should do? So in most cases people focus on how to trade. They don't think about how do you think when you're trading. So basically when you talk about psychology, trading psychology, we are teaching you how you should think when you are trading. We're trying to cultivate and cultivate the right profitable mindset that you should have when you're taking your trades. Then we also have a course where I'll be teaching risk management. I'll teach you trade wisely, trade confidently, hint of what we'll be talking about. So what is risk management? Risk management is all about capital preservation and ensuring there is. My wife laughed at me yesterday when I wanted to pronounce that word, and I'm now thinking that it's gonna be a disaster. How do you pronounce this word? Mayane. Longevity. And you're ensuring that you're preserving your capital. So basically, when you talk about risk management, we're looking at capital preservation, which is one of the things that most people, the reason why you're blowing your accounts, guys, and you're losing in trading, you're failing to see the importance of what risk management in your trading setup. So risk management, we are trying to stay as long as possible in that you are there. You're trying to maximize your rewards and minimizing your risk so that you're in a position to capitalize when the market gives you an opportunity to win. Sometimes you lose because of one or two trades, but maybe on the fourth or the fifth or the sixth trade you're going to be winning. I have a very good trade, 13 trades. He's embarked on he's doing a pro firm challenge. Because of proper risk management, he lost 12 trades and won only one. You know, he was down by what? He was down by 2%. Why? So this is the importance of what? Risk management. If you don't have risk management and you're only focusing on good trading strategies, you'll see that in this Forex market, in this trading business, you are not going to live long. You're quickly going to what? To leave trading because of losses. So if you have a proper risk management, end up being profitable. So over the weekend, if you're interested, you can join us where we'll be teaching you guys on risk management and also what trading psychology. So basically over the weekend, we'll be focusing on these two topics. And for your own information, if you don't have money, just contact with me. It's not like we're really focusing on money. We want people to know the things that really brings value to people in trading. So if you don't have money, contact me and tell me, DC, I'm in a position of not, I cannot pay. Is it possible if I can join? But the course will be going for $20. So it will be on Saturday, 7 o'clock CAT time. So if you're interested, you can also be part of this. Thank you guys for your time. I think I should call it a day. Bye-bye for now. Yes, I'm still processing the information. I wanted you to call me and